execution session right now. That's what I'm saying. Whatever flip zones. And honestly, at this point, I'm just not sure if Brad is chatting shit or if he actually knows what he's saying. Because, I've been going over this multiple times. One time he's like really on it, and then another time he's like really tired and he's like, "Ooh, I make a mistake." And so yeah, that's just how we move, bro. That's how we move. Alright, let's go to all the blocks.
To wrap up. Next, let's talk about order blocks. Now, before we move on to the next few lessons, to wrap up this entire institutional zones course module, I need you to make sure that you have fully mastered supply and demand zones first. Because supply and demand zones is really the bread and butter, it's really the foundation when it comes to identifying the correct point of interest. Right? Next few lessons, you're gonna learn a few different types of point of interest that is much more effective than supply and demand zones. Right? Things like order blocks, your liquidity sweep zones, all of these zones are much more effective than your ordinary supply and demand zones. Now, before we move on to those more advanced stuff, like I said, make sure you master the boring fundamentals. Make sure you actually get them right first. Like what Bruce Lee said, I don't fear the man who know 1,000 kicks. I know the man who practice the same one kick 1,000 times. Right? So yeah, please make sure you go and rewatch the past few supply and demand lessons first. Right? Have a very good understanding of them. Complete the exercises. Complete the action steps. Right? Learn how to actually mark them up onto the charts before we dive into the next few lessons. If not, then welcome to order blocks. Right?
Brad is the Matrix. He is the Matrix. It's like Andrew Tate, the other Matrix. The full for the highest level of temptation. The fucking power, bro.
Order blocks, they are basically pretty much the same as supply and demand zones. And the definition of order blocks is really areas where a large number of buy or sell orders are executed. If you listen to this definition, it sounds pretty much the same as supply and demand, right? Before we move on, just think about it from first principles. What are we doing as retail traders? What is our goal? Our goal is to trade with the smart money, the big financial institutions, the banks, the smart money, right? Basically, because they are the ones that actually move the market. So earlier on, when we go through supply and demand zones, we know that okay, example here, there is a demand zone right here, and then all we are doing is that we are waiting for price to pull back to the demand zone, and then that is when we can enter for our trade. And then the rationale behind this is that okay, smart money entered for a sell position right here at this area right here. Okay, this is actually a supply zone, I just realized. Let's say smart money enter for a sell right here, with a large amount of orders, right? That's what caused price to break out of this consolidation to the downside. And then now, smart money is going to enter again when price mitigate this area. So that is when we want to enter. So if you look at this, this is pretty much all we are doing. We are looking at the zones, we are marking them up, those zones that signal to us that smart money have entered for the trade. And these zones allow us to know when smart money are going to enter again. And that is when we get in with them. So, same thing with order blocks, right? But the only difference here is that order blocks are basically areas where there's a large number of buy or sell orders executed, right? So, to understand, before I explain this, like what are order blocks, I want you guys to understand the why behind it, right? The psychology behind order blocks. If today, smart money, they want to enter for a large amount of position, they will not enter all of those positions, millions and billions of dollars at once, right? They will not enter for $100 million worth of sell position at one shot. No, they're gonna split it into different sizes of orders, right? Different orders, and that is when the order block terms come into play, right? So, example, this is a large order, okay, and then they're gonna split it. They're gonna split it like slicing a pie, right, to different parts. Part one, part two, part 3, part 4. Let's say they split this entire $100 million order to 4 parts. So that's like 25 million, 25 million, 25 million, 25 million. So, example, when an order block is being created like this, and they enter the first slice of the pie, so they enter $25 million right here. Okay, cool. That caused price to move out of this consolidation to the downside, like a lot of money pushing price to the downside. and then order block is being created. So the next time price actually pull back up to the order block, they enter their second part, another 25 million. Boom, then cause price to drastically move to the downside again. So that's basically what order block does. It allows us to know where smart money have entered for the trade and when they're going to enter again, so we can enter with them, right? So that in this way we can really catch those large imbalance in price. So now order blocks, this is basically what it looks like. Let me just explain to you in a bullish scenario. So in a bullish scenario, right, we can expect price to be in a downtrend, or this could be like from a continuation just like this, whatever, right? So as long as you see this sharp pivot movement, right, where price move down and then sharp go up, right, sharp substantial upward movement, this is what we are looking for. You just need to identify the pivot candle. Once again, you have learned this inside your supply and demand zones, right? The candle that caused this substantial upward movement in price. So this pivot candle, the criteria is that it must take out the previous candlestick low. So this candle, it must close below the previous candlestick low, right? So in this case, it did, so it's counted as a valid order block. But if this candlestick is actually all the way down here, right, the candlestick wick extend all the way under here, this one did not close below the low, so this is not considered as a valid order block. So this pivot candle must take out the previous candlestick low. And then after that, it must create imbalance, right? That means there must be a gap that is formed right here that tells us that smart money actually entered into the market that causes this candlestick. But pivot candle, what we are looking could be like from a continuation just like this, whatever, right? So as long as you see this sharp pivot movement, right, where price move down and then sharp go up, right, sharp substantial upward movement, this is what we are looking for. You just need to identify the pivot candle. Once again, you have learned this inside your supply and demand zones, right? The candle that caused this substantial upward movement in price. So this pivot candle, the criteria is that it must take out the previous candlestick low. So this candle, it must close below the previous candlestick low, right? So in this case, it did, so it's counted as a valid order block. But if this candlestick is actually...
Yo, that's a key point right there. That's a hard one to word, bro. Pivot candle. Order block must take out previous candles low.
to wrap up this next, let's talk about order blocks. We are so the gap actually formed. So this candle, it must close below the previous candlestick low, right? So in this case, it did, so it's counted as a valid order block. But if this candlestick is actually all the way down here, right, the candlestick wick extend all the way under here, this one did not close below the low, so this is not considered as a valid order block. So this pivot candle must take out the previous candlestick low. And then after that, it must create imbalance, right? That means there must be a gap that is formed right here that tells us that smart money actually entered into the market that causes such a huge amount of imbalance in price, right? So how we identify this gap is by looking at this pivot candle, the next candle, and the next candle after this candle. So the gap actually formed right here from this candle's lowest point right here and the pivot candle's highest point, and you can see this is the gap, right? When there is a gap, that means there is imbalance in price, right? And once again, what does this mean? This means that the smart money have entered into the market and they have really entered a large amount of orders which cause this imbalance in price. So obviously we need to have a sharp and substantial upward movement, and then when if a fulfill this criterion, and the order block is formed at the last bearish candle before this sharp upward movement. So if you find the last bearish candle, it will not be this one, it will be this one right here, because this one is the last bearish candle that caused this entire upward movement. Alright, so now your job is just to wait for price to pull back to the order block, and that is when you can potentially enter for the trade, enter for your buying position and trade the continuation. Right, same thing, your order flow, range, initiation, mitigation, continuation. And then for a bearish scenario, the pivot candle must take out the previous candlestick high, right? So it must take out this high right here, which it did. And then once again, imbalance being created from here till here. You can see this gap, right? So this is when we want to see that sharp and substantial downward movement, and that creates our order block. And we just wait for price to pull back to the order block, and then that is when we can enter for our trade. Now, in order blocks, more often than not, we actually refine our zone to the pivot candle itself. So instead of marking out the entire range, we just refine it to the last bullish candle in a bearish scenario and the last bearish candle in a bullish scenario to actually identify our order blocks. Okay, cool. Now that you got the basics out of the way, right, just to answer this question right here, because I believe this is one question that you guys probably have in mind right now. What's the difference between order blocks and supply and demand zones? Now, like I said, order blocks and supply and demand zones, they are pretty much the same. It's just that order blocks are much more effective than supply and demand zones. Because if you think about the psychology behind it, is that smart money, they are entering for a large amount of position, so large that it costs price to create an imbalance in price, right? That costs price to create this huge gap, right? So yeah, so order blocks tend to be more effective, which means there are higher probability of them working out compared to your normal supply and demand zones. And then there's also going to be different rules when we are using when we are identifying our valid order blocks. Like example, this rule right here, right? And also the rule where there must have like imbalance in price, and you will learn about it next. Yeah, so basically these are the main differences, right? Order blocks and supply and demand zones are pretty much the same thing. It's just that order blocks are more effective than supply and demand zone. That is why if you go onto the market and if you identify 2 points of interest, if you see a normal, say there's a normal demand zone right here, and then there is actually another order block right here. So this is an order block, this is just a demand zone. Now you can expect price to actually respect the order block and then go compared to breaking past it and then come down to this demand zone, because the order block is always going to take precedence. It's going to be much more higher probability than a normal demand zone. Alright, next let's go discuss the rules of order blocks, right, so that we can actually learn how to define a valid order block. So these are the rules of order blocks. There's basically 4 rules. I'm going to go through the first 2 and then go through the next 2 later. Now, for a point of interest to be considered as a valid order block, it must meet all 4 rules. It must meet all 4 criterion. If it does not meet a single one of them, it is not considered as a valid order block. You can consider it as a supply or demand zone or whatever, but it is not considered as a valid order block if it does not meet any one of these 4 criterion. So it must, let me repeat myself, it must meet all 4 criterion. So the first rule is that the pivot candle must close below or above the previous candle. Right, so in this case, right here you can see, this is the pivot candle that caused this entire substantial and sharp upward movement, right? So this is when you look at the previous candle before the pivot candle, and you can see this candle, did it close below the low of the previous candle, which is right here? Yes, it did, right? So this is when we can actually identify this as a valid order block. Now the reason why this rule exists is because this candle right here is swept available liquidity from the previous candle, right? So yeah, if you don't understand liquidity, don't worry yet. Like I said, we're going to go through this one step at a time. Later on, you will learn more about liquidity. But this is basically the rationale behind it, right? The reason why this rule exists is because we want the pivot candle to sweep available liquidity. That tells us that smart money has really manipulated price into this area right here. And then on the other hand, you can see in this case, right here, this is the pivot candle, and you look at the previous candle, and you can see this is the low of the previous candle. Did this pivot candle close below the low of the previous candle? No, it did not. So in this case, this order block that you have marked up right here is actually invalid. Okay, the second rule is that price must create imbalance, right, or cause some sort of gap, and that is how you define your valid order block. So in this case right here, once again, how you find this gap is by looking at the pivot candle and the 2 candles after that. So these 3 candles, just focus on these 3 candles. Now, for the pivot candle, you find the high of the pivot candle right here, and then for the third candle, you find the low of the third candle, which is right here. So you can see, if there's a gap like this, right, you can see that there's pretty much a gap right here from here all the way down here. If there's a gap just like this tells us that this is a valid order block. In this case right here, once again, you find the pivot candle the high, and then you find the third candle the low. You can see in this case, there is no gap whatsoever, right, because this candlestick high is actually at the same price at the third candlestick's low, right? Same price, so no gap whatsoever. So this order block is actually invalid. And then the third rule is that it must be unmitigated, right? So unmitigated means it must not be touched, right? So in this case right here, this pivot candle right here, and then this is the order block. Now, you ask yourself, has this order block been mitigated? If it has been mitigated, price must actually come down here, tap into it, touch it, kiss it, whatever it is, and then go. Then that is mitigated. But in this case, it has been unmitigated whatsoever, which means it's going to be much more effective. And compared to this one right here, right? When this order block was formed, the third candle actually come down here and mitigate it, right, before moving forward. So this means that some pending orders have already been filled, right? So this is not going to be a valid order block. It's going to be an invalid order block, and you cannot draw this on there. It's going to be useless anyways. And then the fourth criteria is that it must cause a break of structure or a market shift, right? Basically, it must break some sort of structure for it to be considered as a valid order block. So in this case right here, this order block caused price to break structure, so it's valid. This order block caused price to break structure is valid. And then later on, this is the last higher low in a swing structure, right? And then price comes down there, break past the last higher low, creating our market shift. Now, when we create a break of structure, remember you can draw your order block right here as long as it fulfill the criteria. And then that is when you can potentially look to trade from this order block, right? Look to enter for your sell position right here. So price comes down, pull back to this order block right there, enter for a sell position, and then come down there again, break past the last lower low. So in this case, a new order block is being created right here. So these are the four criteria that an order block must meet in order for you to consider as a valid order block. Like I mentioned earlier, if it does not meet a single one of these four criteria, it is not an order block. So, firstly, quick recap. Firstly, it must create some sort of imbalance. And then secondly, it must take out the previous candlestick low or high. And then thirdly, it must be unmitigated. And fourthly, it must break structure. Alright, if not, let's go look at some examples. Okay, let's look at this example that we have right here. Right, so we are going to go through the validity of this order block one by one from the bottom to the top. Right, so when we look at this first order block, right, the first thing you look at is whether there is a sharp upward movement. Because all we are doing when we are trying to identify order blocks is to look for those sharp upward movement or sharp downward movement in a bearish structure, and we want to see some sort of imbalance in price, right? Ideally, you should see some sort of large ass candlestick right here that does that. There's a lot of momentum, there's a lot of pressure. Okay, so in this case, you find a sharp upward movement. Okay, I see it right here, sharp upward movement, and then find a pivot candle, the last bearish candle that caused this pivot movement, and there will be this candle right here. So look at this candle, you check. Okay, does this candle close below the low of the previous candle? Yes, it did. Okay, next criteria, does it create a gap? Right? Does it create an imbalance in price? So you draw the high and then the low of this third candle. Yes, there is a gap indeed. Okay, cool. Then is this order block unmitigated? Yes, it is, right? Price has not tapped into the order block whatsoever, so it's unmitigated. And then last but not least, did it break structure, right? So it ended up breaking past the last high right here, creating a bullish break of structure to the upside. Okay, cool. If have all four criteria, this is when you can draw your valid order block right there. Okay, so yeah, you can draw it right there. Okay, cool. Then next, after break of structure, we're anticipating price start pulling back, and then it starts pulling back. Okay, cool. That's when price starts pulling back, come all the way down here. And you can see it later on continue the uptrend, right? Continue this upward movement, causing a break of structure. Now that is when you can identify your order block, right? So I look at the pivot candle right here, then I ask myself, okay, did this candle close below the low of the previous candle? No, it did not, right? You can see because the previous candle, the lowest point is actually all the way down here. So this pivot candle did not close below it. In this case, this will not be a valid order block since it did not fulfill the first criteria. Now, obviously in this case, later on price actually go up there and then starts pulling back again. Okay, it starts pulling back again, that is when you can start finding your order block again. So in this case, you can see this case right here, this candle actually closed below the previous candlestick low. Cool, nice. And then this one right here, it actually causes this order block to be mitigated, right? Because right after this order block, even though it met all three other criteria, right, it broke structure, it closed below the low of the previous candlestick, and then it also caused okay, actually it does not have a gap. Yeah, so it met 2 out of the 4 criteria. So in this case, it was mitigated and it also did not have a gap, right? Because this third candle is right here, and then this pivot candle is right here. So there's no gap. Okay, this is not really counted as gap. So actually this is kind of, yeah, let's just put it like this. Okay, so yeah, I can see no gap whatsoever, and it's also been mitigated, so this is an invalid order block. Alright, and then later on price goes up there, and then starts pulling back once again, and then goes up even further. So in this case, you find the pivot candle, maybe this one right here. So this candle did close below the previous candlestick low. Yes, it did. Right. Okay, actually right here, right, when I say close below the previous candlestick low, right, the candlestick does not need to physically close like below the low like this, right? As long as this candlestick actually break below the low of the candlestick, the previous candlestick, it is considered as a valid. All right, so think of that. As long as the pivot candle actually break the previous candlestick low, it's considered as a valid order block. Right, so in this case, it closed, yes, and then it leads to this bullish break of structure to the upside. Okay, it caused a bullish break of structure. It's unmitigated as well, and then it caused imbalance in price. Okay, to get imbalance right here. Okay, ideally, right, the imbalance should be much bigger, right? So ideally, it should be like this, right? You can see there's a very clear imbalance in price, just like this. Okay, that is when this is considered as a valid order block. Alright, that's pretty much for order block, right? So, like I said earlier, you should not be thinking about order blocks and all of this advanced stuff if you have not mastered supply and demand zones whatsoever, right? The last thing I want you guys to do is to confuse yourself with all this additional zone. Think about, right? So, ideally, it should be like this, right? You can see there's a very clear imbalance. Price, just like this. Okay, that is when this is considered as a valid order block. Alright, that's pretty much for order block, right? So, like I said earlier, you should not be thinking about order blocks and all of this advanced stuff if you have not mastered supply and demand zones whatsoever, right? The last thing I want you guys to do is to confuse yourself with all these additional zones, right? All these additional institutional zones. Just remember, all these order blocks is truly just supply and demand zones, right? If you think about it, it's really just supply and demand zones. It's just that there are another term for more effective supply and demand zones. It's a higher probability supply and demand zones. So ideally, when you go into a blank chart, go and mark up all your supply and demand zones, and chances are some of them could potentially be order blocks. So just remember, not all supply and demand zones can be order blocks, but all order blocks can be supply and demand zones as well, right? So it really depends on the criteria, whether it meets the 4 criteria. If it meets all 4 criteria, then yes, you can consider it as a valid order block. If not, then it is not an order block whatsoever. It is just an ordinary supply and demand zone, or it might not even be a point of interest, you know? All right. Right. Alright, now let's try to identify some order blocks on the chart itself, right? So I'm just have like a list of like the 4 rules of the order block on the screen right now, so that it allows us to really easily identify those order blocks, right? And remember, when we actually identify order block, the first thing we want to see is that sharp price movement, right? So based on this, you can see there was a sharp downward movement in price, right? So that was in fact like some sort of order block right there. And then there's a sharp upward movement, right? So based on this, you can see that, okay, there is a bearish order block right there, right? So this will be the last bullish candle that caused this sharp downward movement. So this will be the bearish order block. In this case, just mark this up right there, and then you ask yourself, okay, did the pivot candle right here take out the previous candle? Yes, it did, right? It closed above the high of the previous candle. Did it cause imbalance in price? Now, at this point of time, right, you can see this is the tricky part. It must cause imbalance in price. So in this case, you can see this, there's no gap, right? If you draw the order block right here, there is no gap. But if you look at this pivot candle and the next 2 candles after that, there's this is the low of this pivot candle, and then this is the high of the pivot candle. Okay, you can see there is a gap. So in this case, I will actually draw my order block instead on this bullish candle. It will be on this pivot candle itself. Alright, then I go through the checklist again. Did this candle take out the previous candlestick high? Yes, it did. Right? Did it cause imbalance? Yes, it did. There was imbalance right there. Is it unmitigated? Yes, it is. Right? So because at this point of time, when it was being created, it is still unmitigated. And then did it cause a break of structure? No, it did not. Not yet, right? So you can see, okay, eventually price actually mitigated it, right? So this one is no longer valid whatsoever since price already mitigated it, and then later on, then it caused this break of structure, right? So this is when this order block could have been valid, but it got mitigated right here where price actually went in there, utilized it, and then caused price to go down even further. So this is where it has already been used, right? Remember, order blocks is a one-time use. So in this case, price actually pushed down to the downside, came back up, mitigated.
So they say it's a one-time use, yeah. But if you buy from down here and aim for the order block, you're getting instant cash.
It caused price to move down even further, right? So based on this, you can just get rid of this order block itself, and then looking at what we have right here, there could potentially be another order block right there, right here, right? So you ask yourself once again, you go through this entire checklist, right? Did it take out the previous candle? Yes, it did. Okay, once again, you can put it into this inside mark candle if you want, or you can just put it in this candle right here. Doesn't really matter. You ask yourself, did it take out the previous candle? Yes. Did it cause imbalance? Okay, this and this. Yes,
So
lots of imbalance right here. Right, and was it unmitigated? Yes. It did cause a break of structure? Yes. Alright, so cool. There we got our valid order block. Right, so right now, this is a bearish break of structure. Right now, the structure is bearish, right? So since the market structure is bearish, our expectation is that price is going to create lower highs and lower lows. And since right now price has just created a break of structure like this, we are anticipating price to start pulling back right here, react from this order block to create a lower high and cause price to go down even further. Right, that is our expectation. So let's bring price forward a little bit and see. Okay, price eventually pull back. Right, you can see it mitigated. Right, you can see right here. It mitigated right here. This is when all the orders, the remaining orders that we have within this order block is filled up, and then cause price to move to the downside. But then look at what happened next. Price actually went up and actually, completely blew past this order block. In this case, look at what price did in the end. Price actually ended up closing above the last lower high, giving us our market shift. So at this point of time, the market has officially shifted from bearish to bullish. So that is when, since this order block has failed, right? I mean, it didn't fail. It did do its job right here to fuel a little bit of selling pressure, right? Cause price to pull back before price goes up even further, right? Since this has been used, we can just get rid of that. And now I'm looking for other order blocks to fuel this little uptrend that we have right here. Because right now, after this market shift, you're expecting price to start pulling back to an order block right here and then potentially hit up even higher. So that is when I'm looking for that sharp and substantial upward movement, and I find the pivot candle, right? You can see in this case there's a few, right? This is when price goes up, pull back, and then goes even further, goes up, comes down, and then goes up even further. So based on this, if I look at the most recent one, it will be this candle right here. But you can see, did this candle actually take out the previous candlestick low? No, it did not, right? So in this case, you look at the next candle, all right? You look at the next candle right here. Did this candle take out the previous candlestick low? No, it did not, right? You look at this candle right here. Okay, so in this case, this is not really valid already. You can see this has already been mitigated, right? You can see price push up there, right? Pull back and then mitigate it and then go. Now, however, what about this one right here? Right here, right? Where price actually pull back a little bit before we get a sharp movement in price. So you put that up there. So I'll drag this up. This entire candle right there, you can see this would not be counted as well because it has already been mitigated by this candle right here. So in this case, okay, since like in the recent area, we don't really have like a order block, right? Of course, you can in fact mark this up as your demand zone, right? But this is not an order block whatsoever because it has been mitigated. Now, what about this one right here? Now, if we have to mark up this one, last bearish candle right here, you drag it all the way up there, it has been mitigated as well, right? So based on this, all of these order blocks have been mitigated. If I mark this one right here, it has also been mitigated. So I guess the only one could potentially be the extreme end right here, right? Could potentially be the extreme end right here. Yeah, it could potentially be at this extreme end, but also the extreme end has been mitigated as well, right? So in this case, there's actually no order block whatsoever, right? I can't seem to find any order block because if you look at this extreme order block right here, did it take out the previous candlestick? Yes, it did. Did it cause imbalance in price? Yes, it did. And then, is it unmitigated? No, because price has already mitigated it. And then, near break structure? Yes, it did. But it has been mitigated. You can see, since we have not met just a single criterion, which is the fact that it is already mitigated, it is not considered as an order block whatsoever. Right, so based on this, there's no order block for me whatsoever. Obviously, you can see price is going to pull back to some sort of demand zone, right? See that there could potentially be some sort of demand zone right here within this area right here. This would have been a demand zone, a very nice demand zone where price is reacting from, and cause price to go even further. Okay, cool. Right, this is not an order block whatsoever because it has been mitigated, right? So just get rid of that, and now it just caused a bullish break of structure to the upside. Alright, cool. This is when to identify.
Yes, indeed.
My new fresh order blocks. I want those order blocks to be as fresh as possible, right? So based on this, once again you can see pivot in price right here, sharp price movement, sharp upwards price movement. Did this candle actually take out the previous candle? No, it did not. This one did though. This one take out the previous candle, but then at this point of time, yeah, this one has been mitigated as well. And then you can see price pull back to this area right here. Okay, cool. Another sharp upward price movement right here. There's an imbalance right here. Did this take out the previous candle? Yes, it did. And then is it unmitigated? Yes, it is. And it's a break of structure as well. All right, cool. Then we have a valid order block. Now, when you look at this, go through this, check this, right? Just go through it in this order to make things simple. All right, you ask yourself, did this candle take out the previous candle? So you can see in this order block right here, the last bearish candle that caused this bullish, sharp, and substantial upward price movement, it was this candle right here. But if you look at this candle right here, did it actually take out the previous candle? Yes, it did. Okay, cool. But it doesn't make sense for you to draw it there because price has already traded below that candle. You can see it right here. Price is already traded below this low. So it doesn't make sense. So you refine it to the next candle, right? So you go through this entire checklist again. Did this candle take out the previous candle? Yes, it did. Did this candle cause imbalance in price, right? So that's when you try to find, okay, at this high right here and the candle right here, there was in fact a little bit of imbalance. Yes, there is. And then is it unmitigated? Yes, price is not mitigated and then go. No, it's fresh zone whatsoever. Did it cause a break of structure? Yes, it did right there. Okay, cool. That's the first order block right here. And then is there order block right here? Perhaps right here. Right here, yeah. That could potentially be another order block right there. Fresh order block right there. So, yeah. You can see sometimes, right, I can just draw it like this. But then the next candle actually traded below the low of this pivot candle. So in that case, I'll just take up the lower part also. Right, the entire low of the next candle. So this will be the entire order block. Right, so based on this, okay, cool. Now I got two order block and I can expect price to actually pull back to one. Okay, pull back to this, you can see, mitigating this one. See, does it respect it or not? Nope. Completely no, and then it came all the way down here to the extreme end of the order block, right? Potentially gonna respect the extreme one, and then go up even further. Nope. Okay, yeah, you can see over here, sweep a little bit of liquidity right here, right? Later on, you will learn about liquidity, right? But in this case, price came all the way down here to this extreme order block, fill up the remaining orders, and cause price to move up even further. You can see right here, cause price to move up even further, where there's a lot of demand step into the market and cause price to move up. Now, obviously, you can see in the end, price actually traded lower into this zone right here. Why? Because there's actually a demand zone right here. And later on, you will know that this is actually a very strong zone because you also swap available liquidity to the left-hand side, right? So you can see price later on come down here. Yeah, so based on this, yeah, right there. Yeah, that's a very strong demand zone and then cause a break of structure to the upside. Okay, cool. That is when you just draw your order block again. Right, go through this entire box again. Since you can see, right, since this has been mitigated already, this one cannot be used anymore. So I'm just gonna delete that. And then right now, since there's a fresh break of structure, that is when I will go through this entire criteria again. Where's the sharp upwards price movement? Okay, right here. And then where's the most recent one? Maybe this one right here. This is the last bearish candle that caused this entire upward price movement. Okay, cool. Take out previous candle. Yes, it did. Cause imbalance in price. Yes, they did. There is a little bit of imbalance right there. And then is it unmitigated? Yes, they did break structure. Yes. So this is a valid order block right there. And then over here, there's actually price pulling back and go up even further, right? So in this case, you could potentially identify your order block right here as well. Right, okay. Right here, look at this. Okay, did this candle take out? No, this one did though. You can see right here, right? In this case, when I'm selecting the order block, I want to make sure that the candle that actually created the order block, it actually take out the previous candle. So in this case, the pivot will be right here, but this is an inside bar candle, which means it did not take out the low of the previous candle. You can see right here, it did not take it out whatsoever. And this candle also did not take out the low of the previous candle, right? You can see right here. So in this case, I'll just mark it up at this bullish candle right here. This one did take out the low of the previous candle, so this is valid order block. But the thing is, it has been mitigated, right? You can see right here. The price is going up, mitigate it, and then go up even further. So in this case, it has been mitigated, so this is not really valid whatsoever. So I'll just get rid of that. So it seems like this is the only valid order block that we have in this case, and potentially price will come down there, react there, and then go up even further. Now, one key thing to note is that price does not always have to react to the order blocks. That's the thing about order block, right? Sometimes price will not react from it, right? Price can make like a minor pullback just like this to maybe some sort of demand zone that we have right here, and then just goes up even further. It does not need to come down to the order block, right? There are other ways that smart money can actually look for to actually fill up their remaining orders, i.e. by at a demand zone, right? Price step into the demand zone, just goes up even further without coming down to the extreme order block that we have right here. In this case, you can see price consolidate a little bit right here. You can see it just utilize this demand zone that we have and then move to the upside. That is why I say order blocks, they are extremely high probability, but then it is not going to work 100% of the time. Sometimes price is just going to respect to a supply and demand zone and then just fill up the remaining orders and then go. In this case, you can see right here, if we were to actually mark out our demand zone, it will be this entire pivot range right here, right? This entire range you can see price respect the demand zone and then went up. Okay, cool. So in this case, another bullish break of structure to the upside. That's when you can move your order block from here. I mean, okay, actually I wouldn't move it because this has not been mitigated whatsoever. So price could potentially come down here and use this in the future, right? Maybe in the future. So I'll just leave it there. And then based on this, I'll mark up my new order block and it will be sharp upwards price movement right there. Okay, potentially this one right here. Yeah, but this one has been mitigated already, so move it to the left. Right here, it has been mitigated as well. You can see price pull back into it and then go even further. So I find right here, potentially right here. Okay, you can see right here. Is this mitigated? Right here, this is the last one. Did this stick out the previous candlestick up? No, yes it did. Did it cause imbalance in price? No, you can see there's no imbalance whatsoever right here. The next few candles, no imbalance whatsoever. Yeah, so I wouldn't really consider this as a valid order block. And also it got mitigated right here. You can see price actually touch it a little bit and then go even further. Right, so in that case, it's not really valid. Right, so how you can really use it is to really make sure you trade the first mitigation. So example right here, if the order block, okay, so right here we have drawn up this very nice order block right there. Okay, maybe perhaps not even there. Right, yeah, maybe, you know what, let's just draw the order block right there. And now I'll place my entry order right here at this edge of this order block, place my stop loss below this order block, and I'll potentially target like this high right here, this weak swing high right there, right? Or maybe I want to enter at a 50% whatever, right? And obviously there's other ways to define that zone, right? This is not a very good risk to block ratio, but you can see how this order block works, right? You tap into it, fill up the remaining orders, and then price just explode to the upside, right? That is why order blocks are so effective, because it allows you to actually get in early. And the thing is that it's a one-time use. That's the only downside. That means if the first time round, when price actually mitigated, you didn't get in whatsoever, you cannot use it again. Yeah, so in this case, you can see there's all of these order blocks right here, right, where it was being traded. Example, this one right here at this extreme end. Okay, if you were to use it for the first time, right, price potentially mitigate it right there, sweep a little bit of available liquidity. Once again, you'll learn about liquidity later on, and that is when you can potentially get your entry, right? And then that is when you can potentially take this to the upside. Right, so in this case, since this one has been mitigated, it's not counted whatsoever. But what about this one right here? This one right here. You can see sharp upward price movement. Okay, cool. Did this candle take out the previous candle? Yes, it did. Did it cause imbalance in price? Yes, this is a very obvious imbalance, right? If you look at this candle right here and the third candle right here, very obvious imbalance. Yeah, a lot of imbalance. You can see very aggressive price movement, right? So this is a very clear sign that the banks and the financial institutions actually enter for the trade right here. Very, very clear sign. And is it unmitigated? Yes. Did it cause break of structure? Yes. So you can see based on this is a very strong zone. I can expect price to pull back to this area, right? It's a very strong zone, right? You can see there's a price potentially goes all the way up there, okay? You can see it's unmitigated, right? It's unmitigated right there. Sometimes because of a lot of momentum like this, right, the momentum can just continue and sustain without making like major pullbacks like this, right? But you can see this is just unmitigated point of interest that we can look to see what price does. When price consolidate here a little bit, right? Come back to our, I think there's another on block right there. Okay, it will be this candle right there. Yep, that will be the order block right there. Okay, just zoom in a little bit. Okay, this sharp upward price movement like this, you can see there's one here, but this one has already been mitigated, right? So maybe actually this one, no, this one is not really counted. Yeah, because this one has been mitigated. And then if you look at this one is fresh, right? Take out previous candle, yes, cost imbalance in price. Okay, this one, no, it did not really cause imbalance in price. You can see there is no gap between this candle and this candle right here. It's just like a straight line like this, right? So in this case, this will not really be considered as an order block. However, once again, if you look at this, what is this? This is just a demand zone, right? Demand zone that in fact caused a bullish break of structure. Since this is an institutional demand zone, we can actually expect price to actually respect this zone and actually go even further, right? So you can see price come down here, tap into the demand zone, then go even further. Alright, yeah, so basically get the point right here. Order blocks, the thing about them is that they are not really rare, but they are uncommon compared to supply and demand zones where you can pretty much see them every day. And you can see in this case, price respected this demand zone, go from there, and cause this order block not to be tapped into, right? So I see this question a lot inside the community, right? You guys ask, okay, why price did not tap into my order block? It just goes. In that case, most likely it tapped into some sort of supply and demand zone and then go. Or it could be because, in this case right here, there's a lot of momentum, a lot of pressure to the upside, right? And that is when, since there's so much momentum, price could potentially make a minor pullback just like this and then go even further, right? That's just how price works. When it has so much momentum, it's very less likely that it's going to make a major pullback to this order block and then go even further. Yeah, so the thing about order block, I want you to get this through a thick skull, right, is that price does not have to actually pull back to this order block and then go. Sometimes it can pull back a little bit and then go even further. Sometimes it can pull back to some sort of demand zone that we have right here, which is above the current order block and then go even further. That can happen as well. Price does not have to pull back to the order block. But when they do pull back to the order block, you can expect that strong reaction in price, right? Like what we have seen, say like right here, right? When price pull back into this order block, strong reaction in price. Or right here, example, price pull back into this order block right there. Okay, this is not really order block. Okay, price pull back to, yeah, say this one right here. Price pull back to the order block, strong reaction in price. You can expect this strong reaction in price when price pull back to the order block. And like I said, these order blocks are rare, right? But they are, yeah, you can see they are rare, but they are very high probability. So in this case, you can see price came down into this order block that we have right here, right? And okay, no, this is not a valid order block because we discussed that this is just a demand zone because there was no imbalance, right? So in this case, you could potentially get a market shift to the downside right here. Okay, cool. Yeah, you can see market shift to the downside. Now I want to discuss something that is a little bit more advanced for you. Those order blocks that have been broken, they become what I call breaker blocks, or what they call breaker blocks, right? So the thing about demand and supply is that supply zones, once they are broken, they act as demand zones. So example, in this case, this is a supply zone, previously supply zone. Once they are broken just like this supply zone actually become demand zone, which means price is most likely going to pull back to this demand zone and then go even further. Same thing with order blocks. When order blocks, like example right here, there's an order block right there. Once they are broken, they actually become breaker blocks, right? Let me just type that out for you. Breaker blocks, right? That means price is most likely going to pull back to this model or this order block that has been mitigated. Come back down here, right? Tap into it and then move up even further. So you can see this supply zone became a demand zone. This order block became a breaker block to fuel price up even further. So yeah, that's something advanced, right? But I don't really want you to worry about that. Yes, this is something good to know. Yeah, it's just a good to know, alright? So in this case, you can utilize that knowledge or you can just keep it at the back of your mind, doesn't really matter, right? So in this case, you can see price step into this area right here, right? This is the entire demand zone range. If you just look at this is the entire demand range right there, right? Price step into the demand range and then just went. Okay, and then you can see price is consolidating a little bit there, and then goes even further. Okay, cool. Yeah, you can see that you can draw more order blocks right there. Yeah, you can see right here, this would be a nice order block right there. Oh, this one right here, this one is fresh. Okay, perhaps I want to show you an example of a breaker block. Okay, so in this case, during this upwards movement that we have right here, you can see you can identify your order block right there. Right, you find this sharp upward substantial price upward. Oh, God damn it, it's so hard to freaking pronounce. Sharp and substantial upward price movement. Okay, they'll find the candle that caused this, the last bearish candle will be this one right here. So based on this, did this candle break below the previous candle? Yes, it did. Did it cause imbalance in price? Yes, it did. Is it unmitigated? Yes, it is. Did it break structural? Yes, it is. Right. So based on this, let's do play price back a little bit. Based on this would be my order block. Okay, and earlier on, like I mentioned just now, if an order block has been broken, it becomes a breaker block like this. You can see it has been broken like this. That means this is going to act as some sort of supply zone for price to react to move down even further, right? That is what a breaker block does. After order block has been broken, it becomes a breaker block, which means we can expect price to pull back to this zone right here and then go down even further. what's the rationale behind this? You must always understand the rationale. The rationale behind this is that all the people who place their buy orders at this order block right here, let's say right here, okay, as soon as price step into this order block, their buy orders get triggered. Alright, so this is when potentially a lot of retail traders or a lot of institutional traders like us, they enter for a buy here, right? Since they see price pulling back to this order block. So cool, they got a lot of buy position right here. And then price eventually fail this order block. So now when price fail this order block, they want to actually close the position. They want to close their loss and get out of their loss at like they want to minimize their loss. So they want to get out of their loss as soon as possible, and they're gonna get out around here. Since price has broke past this area right here, and this is where they entered, and they want to get out at like break even, or at least just a little bit of loss, this is where they want to get out. So this is when price pull back to this area right here, they are gonna get out of their buy position. And when they get out of their buy position, those positions get converted into sell position, right? Because in order to exit your buy position, you have to sell, right? So now there's going to be a lot of selling pressure at this area right here, because all the people who entered for buy right here, they got out and converted all their buy position into sell position, which means there's going to be a lot of selling pressure to drive the price down even further. And that is when you can expect price to actually start going down even further. You can see in this case, price respected this order block here, and then go down even further, right? You can see it went down even further right here, right? So that's basically the rationale behind it. Once again, this breaker blocks is just an additional concept for you to know. It's a good thing to know, right? It's just an additional knowledge that you can utilize it to your favor or not. Yeah, but once again, I don't want you guys to confuse yourself too much at this point of time. Keep things simple, stick to supply and demand. Use this order block knowledge as like an additional weapon in your arsenal to actually give you more evidence on when to actually enter for the trade, and when to really predict like those sharp price movement in price, and when smart money have entered into the trade, identify it, and then find out when you can actually enter again at these order blocks. Yeah, anyways, yeah, please keep things simple. Don't overcomplicate things, right? Have certain rules in your arsenal. Stick to those rules and just keep on following them to the day that you die. As simple as that. Yeah, don't confuse yourself too much with this breaker blocks stuff. It's just an additional knowledge for maybe advanced traders or intermediate traders. Yeah, but for now, just focus on supply demand zones and order blocks. And yeah, next, let's go through some other zones. Right, once again, just remember, if you get too confused or overwhelmed by all these different type of zones, just stick to supply.
Stick discipline.
And then there are some. Okay, so far you have learned about supply and demand zones and flip zones. And then there are some other zones that you actually want to watch out for when you are trading. Now, bear in mind, all of these zones that you see on the screen right now, at this point of time, at this stage of your trading journey, you don't really need to know them yet, right? Later on, when we go on to liquidity concepts, right, when you advance to the advanced liquidity concepts course module, you will learn more about these zones, right? But now, I just want to share with you guys, these zones exist, what are they, and how do they work, right? So that if you are curious, you can learn a little bit about them right now. But later on, like I said, later on, as you progress through this entire course, you will learn more in-depth about these few zones, alright? So, first of all, liquidity zones are basically zones that have swept liquidity. Now, what is liquidity? So, right now, okay, if I explain about liquidity, I'm going to explain it for another 1-2 hours, alright? So, I'm going to leave that later on. Later on, you will learn about liquidity and liquidity concepts and everything that comes together with it. For now, I just want you to know that above every swing high, there will be liquidity. Below every swing low, there will be liquidity. Which means at some point of time, price, or rather smart money, they will push price up above this swing high, grab that available liquidity to cause price to go down even further. Same thing with swing low, right? At some point of time, price will go down, sweep the available liquidity above this swing low, below this swing low, and then cause price to push up. Now, why does this liquidity exist? Example, alright, there's a double top. This is a very famous chart pattern where we see retail traders, when they see
Wait, I know I've got the string.
right, so that if you are curious, you can learn a little bit about them right now. But later on, like I said, later on, as you progress through this entire course, you will learn more in-depth about these few zones. Alright, so first of all, liquidity zones are basically zones that have swept liquidity. Now, what is liquidity? So right now, okay, if I explain about liquidity, I'm gonna explain it for another 1-2 hours. Alright, so I'm gonna leave that later on. Later on, you will learn about liquidity and liquidity concepts and everything that comes together with it. For now, I just want you to know that above every swing high, there will be liquidity. Below every every swing low, there will be liquidity, which means at some point of time, price, or rather smart money, they will push price up above this swing high, grab that available liquidity to cause price to go down even further. Same thing with swing low, right? At some point of time, price will go down, sweep the available liquidity above this swing low, below this swing low, and then cause price to push up. Now, why does this liquidity exist? Example, alright, there's a double top. This is a very famous chart pattern where we see retail traders, when they see this, they're going to be induced to actually enter for a sell position. So this is what we call an inducement, right? It's basically traps set by smart money to bait, to induce retail traders to take the opposite side of their trade. Alright, so example in this case, we see a double top chart pattern just like this. Retail traders, when they see this, they're going to think that, oh, price is going to go down right now, so I'm going to enter for a sell right here. And then I'm going to place my stop loss.
Mate, that one is busted. This is the craziest one. It dips so fast and buys back so fast.
Above these equal highs, right? So when they do that, guess what? That's liquidity being formed. Now, why? Because when they enter for a sell right here, if they place their stop loss above these equal highs, if their stop loss get triggered on their sell position, their stop loss become a buy. Their sell position will be converted to become a buy position because they have to buy back the asset that they have sold, right? So that is why there is liquidity right here. So that means there's potentially, what smart money will potentially do is that in the near future, price, they purposely manipulate price and cause price to move up and sweep all the available liquidity that we have above these highs, right? Grab all the buy orders, once again, bait all the retail traders, get them out, and then this liquidity is able to fuel the smart money positions, their big buy orders, their big sell orders, and cause price to go down even further, right? And in that case, guess what? Those people who enter for a sell right here, they get stopped out right here. All the retail traders, they get stopped out right there, and then smart money manipulate price and cause it to go in the other way. Now, once again, if you don't understand what I'm saying right here, don't worry. You will learn about this in much more detail when you go on to the advanced liquidity concepts lessons. For now, just know that there is liquidity above a swing high and below a swing low. Alright, now you're up with that basic knowledge. Let's talk about these zones, these liquidity zones. Now, first one I want to go through is liquidity sweep zone. Now, liquidity sweep zone is basically a point of interest that swept liquidity before it's created. So in this case right here, price push up in an uptrend, right, and then it starts going down, alright, and then price goes up again, and it failed to break past the previous high. Now, when that happens, guess what? There's an equal high right here. Now, when there's an equal high like this, remember, just now we said the retail traders, they're going to see this and they're going to think that the price is going to go down, so they will enter for a sell right here. And when they do that, they're going to be placing their stop loss above these highs. So that is liquidity building up above these highs. Now, smart money, they know this, right? And they are not going to let retail traders get in, win, because if retail traders win, then they kind of doesn't get the available liquidity to actually cause price to go to wherever they want. So at this point of time, what they want is that they want to manipulate price, to push price up there, sweep all the available liquidity that we have above these equal highs, and then cause price to go down. Because when they do this, they're not only able to get all the retail traders out of the market so that they can actually control their market with the amount of money they have, but they were also able to utilize all of these pending buy orders right here to fuel their sell position, right? So, example, right now, if a big company, right, or rather a big hedge fund, they want to sell, let's say, billions of dollars of Euro USD, they cannot possibly sell it immediately, right? They need liquidity. They need someone out there to buy the billions of dollars of Euro USD they're trying to sell. And nobody's going to do that because nobody have billions of dollars available to easily sell them at this particular timing. In that case, they're going to get it from the retail traders. And how they're going to get it from the retail traders? They are going to get it through these inducements, right, where they induce retail traders to enter for sell here, place their stop loss above these highs. Now all of their stop losses are here. If price goes up there, trigger all of these stop losses, and all of this sell position become buy position. And now, if they're able to, if they want to sell the billions dollars worth of sell short positions, right, sell orders, they have these buy orders right here to fulfill these sell orders, right, which allow them to grab the liquidity and fuel and cause price to go down. Now, when that happens, right, this is what we call a liquidity sweep, where price goes up there, sweep the available liquidity before going down even further. Now that is a sweep zone being formed, right? The sweep zone will be basically the top of the reaction to the bottom of the, you can either draw this entire zone, right, or you can just refine it to this area right here, right? It's basically the zone where I swept the available liquidity. And then below here, this is a bullish example. Once again, there's equal lows, inducing all the retail traders to enter for a buy position. That is when smart money purposely push price down, sweep all the available liquidity before price goes up there, creating that sharp V-shaped reaction. And now there is a sweep zone being formed right here, and you can wait for price to pull back there and enter for a buy position. Now that's for sweep zone. Like I said, right now, if you don't understand a single word I just mentioned, don't worry. This is more advanced stuff. Later on, you will learn more about this sweep and flip plus sweep zones. We will definitely revisit this again later on in the course. For just know that they exist, and yeah, just know that they exist. And then next is a flip plus sweep zone, right? So flip sweep zone is basically the same thing as your flip zone, which we have went through already, but instead, when price was creating that flip zone, it swept available liquidity. So in this case, price goes up, pull back, goes up there. Once again, demand zone is formed right here, and then price come down here, tap into this demand zone. Remember, if the demand zone price was going to go up there and break past the last high. But this time around, it did not do that. It created a failed reaction. But right here, when price reacted from this demand zone, buyers stepped into the market before pulling back a little bit right here. Guess what? There is available liquidity above every swing high and below every swing low, right? So in this case, there is available liquidity above the swing high, right? When it starts pulling back like this. So now, smart money is going to push price up, sweep the available liquidity above that swing high before causing price to go down even further, and then creating that flip zone, that flip plus sweep zone right here. So in this case, this zone right here, it not only caused demand to flip to supply, but it also swept available liquidity that we have on the left hand side here. And then you just need to wait for price to pull back to that flip plus sweep zone, and that is when you can potentially get in for the trade. Right, so yeah, you can see how you draw the flip plus sweep zone is that you can draw it from the bottom of this, the bottom of this pullback. Yeah, I mean, yeah, the end of this pullback to the top of this reaction right here. So yeah, basically this entire zone, or you can refine it to just this area right here that swept the available liquidity. Once again, completely up to you. Okay, and then another bullish scenario looks something like this, where price goes down, pullback, goes down, supply zone being created, failed reaction right here, and then guess what? There was a swing low being created, and then price later come down there, sweep the available liquidity before price goes up even further. And now this is your flip plus sweep zone, right? And then price gonna come down there, respect it, and then go up. Now, all these liquidity sweeps does is that it increases the probability of the zone getting respected. So, example, sweep zone just like this is going to be much more better than just a normal supply zone, right? In this case, look at this. Let's say we got one example, this one, and then another example just like this. Okay, it's just another example of a normal supply zone. Now, which zone has a higher probability of working? Which zone is price most likely going to respect and go down? It's going to be this one right here because it swept available liquidity before going down. So a sweep zone will be much more stronger than a normal supply zone. And then another scenario could be, okay, if price goes up there, okay, we get a flip zone right here, failed reaction right here. Now, which zone is price most likely going to respect? A normal flip zone or a flip plus sweep zone just like this? This one right here, right? You can see when we add liquidity, it increases the confluences for that particular zone. It increases the probability of that zone actually working out, all right? And price actually respecting that zone. So next is your trap zone. Now, trap zone is basically a zone without inducement. Remember earlier we talked about how inducement is basically traps or baits set by smart money to induce the retail traders to enter into a position that is opposite of their intentions, right? So in this case, what happened was that price goes down, pulls back, and then go down, right? Very, very nice break of structure, supply zone being formed right here, and then later on price goes up there, and it came up to the same high right here, equal highs whatsoever before price goes down even further. You can see it's a very perfect scenario where no liquidity has been swept whatsoever. You can see there is still liquidity available above these highs, and then right now since price come up to this high, it did not sweep the available liquidity, price did not do this, and then go, then we can get the liquidity sweep, then we get a sweep zone right here. No, it did not do that. It just doing like a very beautiful, very textbook type of downtrend. In this case, we know there's going to be available liquidity being built up above this high right there. Since there's so many liquidity right there, we can expect sometime in the future, price will go up there and sweep the available liquidity before going down. Now, in this case right here, right, what happened is that right here, the retail traders who enter for sell right here, they're going to be placing their stop loss above these highs. And then the people who enter for sell right here, once again, they're going to be placing their stop loss above these highs. That is why there's a lot of buy orders, a lot of liquidity at this area right here. So when price actually breaks structure just like this, cause please break of structure, we can draw our supply zone right here, right? Now, we can expect this supply zone to actually fail because there is a lot of available liquidity above these highs right there. So the next time price actually go up there, seeing these very like textbook equal highs and these very perfect highs right there, right, we can expect this supply zone to fail. We can expect price to go up there, sweep the available liquidity above these highs, and then go down. All right, yeah. So yeah, that's something you need to look out for when you are trading supply and demand zones. More often than not, you will see these supply and demand zones, they tend to fail because there's actually available liquidity above those highs, right? And then same thing with the demand right here. In this case, price goes up, pull back to this same area right here, right? There's a lot of available liquidity below these lows. No liquidity has been swept whatsoever, so we can expect smart money to come down here and sweep the available liquidity in the near future. And then price goes to go up there, okay, cool, very straight move. You can see very textbook movement. It literally looks like all the market structural pictures you see on Google when you search uptrend. Price really just look like this. Available liquidity, available liquidity. Now in this case, this demand zone was created when price actually goes up there and break past the last swing high, right? So in this case, we can expect this demand zone to actually fail because there's available liquidity above these highs, and price is most likely going to come down there, sweep the available liquidity before going up. Now later on, you will learn that, okay, if there is actually inducement within this leg right here, so price, instead of price pushing a straight line like this, price actually did this, where price pull back a little bit before go up even further. Now there is available liquidity below these lows right there, and price will most likely come down there, sweep the available liquidity, and then respect this extreme demand zone and then go up. That could potentially happen, right? Later on you will learn about this, all right? Yeah, so later on you will learn that, okay, if there's an inducement doing the push phase like this, doing the single leg up, this push phase, this impulse phase right here, if price did not go straight up like this, if there's actually like a pullback inducement, we can expect price to actually respect the extreme demand zone, right? And actually the demand zone can actually work. Now, more often than not, when you see such a straight push just like this, right, it's potentially created due to high impact news, right? Your non-farm payroll, your FOMC, when the news come out, cause price to just immediately jump up 100 pips without actually doing like a pullback just like this, without a corrective move just like this. In that case, these are really the areas where we want to be aware of, right? So these are the zones, which I call trap zones, zones without inducement that you really want to look out for, right? You want to be careful. Okay, yeah, once again, the high impact news stuff, you will learn about it later as well. Now, for now, I just need you to know that they exist, okay? That's it. I just need you to know that they exist in the market. Later on, you will learn more about them. You don't even need to know what each of these things do right now. Right now, focus on supply and demand zones, flip zones, basically your basics of your institutional zones, master them first, and then you move on to liquidity concepts, you will learn more about these zones. Alright, yeah. So for now, just focus on, like I said, one step at a time, put one foot in front of the other, and slowly we will get there, and slowly you will think like this right here is a piece of cake, right? And you will later on you will see that there's a lot of variation of this sweep zone, right? Sometimes price can do like this, price goes up there, sweep available liquidity, sweep again, and then price goes out, and then you got like sweep zones right there. Yeah, basically you will learn more about this stuff later. Alright, for now, focus on the basics, focus on supply and demand and market structure. Once you can master these two concepts, then you move on to liquidity, right? And when you move on to liquidity, you will learn more about these zones that we have right here. And then later on, lastly, when you go on to high impact news, you will learn that, okay, there is certain news in the market that actually cause price to move down and up 100 pips. And when a high impact news like this come out, the zones before that is actually trap zone, all right? Yeah, for now, just know that they exist, all right? Before you proceed with this lesson, please make sure that you take note of this big red bold text that we have right here. Do not mark this lesson as complete until you have rewatched this after finishing liquidity concepts course. What you are about to learn is basically how to select the correct point of interest, or rather, the high probability zones that we want to be trading from. And to do that, you need to have a basic understanding of liquidity. So if you have not went through the liquidity concepts courses yet, or you don't really understand liquidity at all, I will advise you to go through this lesson. And if you don't understand anything about liquidity, don't worry. Later on, when you go and learn about liquidity concepts and you finish the liquidity concepts course, come back to this lesson and rewatch it again. And everything will make perfect sense. Alright, so this is my little warning for you. Right? You can proceed and watch this lesson even if you don't understand liquidity, but it will help if you do understand liquidity. And when you eventually do go and learn about liquidity and understand liquidity concepts, what it is, how it works, come back and rewatch this lesson. Alright? If not, the warning is out of the way, and let's get on with this lesson. Right, so let me just remove this ugliest text right there. Okay, so point of interest selection. POI once again stand for point of interest, and it's another word for institutional zone. Alright? So when it comes to point of interest, we know that when we are trading, there's going to be a ton of supply and demand zones, all different sort of zones everywhere and anywhere. How do we actually ensure that the zone that we are trading from actually works? How do we ensure that price will actually respect the zone, right? So example, right here, let's say over here, price goes down, pull back, and then there's two zones being created, right? You can see first supply zone right here, second supply zone. The most common question I get from you guys is that, which zone should I trade from? Should I trade from this zone, or should I trade from this zone? And my answer is always the same. The zone that is gonna work. And how do we know that which zone is gonna work? By looking at what are the confluences that actually back up each zone. Example, this zone has, let's say, a few confirmation, and then this zone has a lot more confirmation and confluences. Then most likely, this zone is gonna fail, and price is gonna come up to this extreme zone with more confluences and react from it. Right? And like I always say, trading is always a game of probability. It's never a game of certainty. Right? Which means this zone, even though it has less confluences, it could potentially work as well. Right? And that's just the nature of the market. We will never ever 100% figure out which zone exactly price will respect from, because you cannot predict what price is going to do. But we can react from it, and we can kind of manage our expectation by understanding how many confluences are hiding behind these zones. Alright, so my philosophy is that the more confluences the zone have, the higher the probability of it working. Alright, so let me just go through a few examples with you. Example right here, right? Example number one. This is just a normal demand zone, okay? Price goes down, pull back, creates a high right there, and then it goes down even further. In this case, supply zone being created right there. And then later on, price actually went up and actually break past the last lower high, giving us our market shift. Now, when we get this market shift, this supply zone failed to do its job, right? So it failed. So we know that demand is in control of price right now, and right now we are turning bullish. So we can draw our demand zone right here. This is the demand zone that created this market shift. Now we can expect price to pull back to this demand zone, mitigate it, and then go up even further. This is literally the basic. If you don't understand this, you shouldn't be watching this at all. This is really the bread and butter. This is just a very basic demand zone. And it counted as an institutional demand zone because it broke structure, alright? So this is really the bare minimum, your demand zone. And then the second example that we have below here, this is a demand zone that actually caused structure to break, alright? But it also caused a flip, right? So what happened right here was that there was a supply zone being created right here as a result of price actually breaking past this last low right there, giving us our bearish break of structure. So we know we have our supply zone at this last lower high. And then in this case, price reacted from this supply zone. Remember, the reaction is key. We want to see that reaction. If this supply zone were to do its job, price were gonna go down even lower, continue creating lower lows and lower highs, right? But it failed to do its job. That's why we got a failed reaction right there. And this is when we get that supply to demand flip, right? Where the supply zone failed to do its job and demand stepped into the market and overpower the supply, right? Causing demand, the buyers to actually take control of the market. So this is our flip zone. So in this case, this flip zone also caused price to break structure, right? So you can see now we've got two confirmation, two confluences, rather than just one just like this. So all flip zone really does is that it gives us increased probability of this POI working, of this zone actually working up. So if we compare zone 1 and zone 2, zone 1 is just an ordinary zone that broke structure. Zone 2 is one that not only broke structure, but it also caused supply to demand to flip. This zone is going to be higher probability than this zone right here. Okay, and then next is this example right here, where same scenario, exact same scenario, it's just that when the flip zone was being created, it swept liquidity. So price actually reacted from the supply zone, come down here, and then goes up a little bit right here, building up available liquidity below this swing low before price comes down, sweep the available liquidity below the swing low, and then go up. And then this is your flip plus sweep zone, right? So this flip plus sweep zone, it swept liquidity, it caused supply to demand flip, and it also caused price to break structure. So you can see there's three confirmation, three confluences when it comes to it. And also later on, when you go through the liquidity concepts course, the lessons, you will learn that there is different variations for this flip plus sweep, right? It doesn't just look like this all the time. Sometimes it will look a little bit. Right? But as long as there is a liquidity sweep, when price is flipping from supply to demand, it is considered as a flip plus sweep zone. Okay, so right now we move on to the final one, which is zone number 4. Right, this one it caused a break of structure. Right, it's pretty much the same thing as this one. It's just that in this case, there's actually inducement being built up right here during the push phase, during the continuation phase. Example, you can see it's pretty much the same scenario. It's just that during this push phase, it was not a straight up push like this. Price actually goes up, pull back a little bit, and then goes up even further. So in that case, there is liquidity being built up below these lows, right? This is our inducement. So right now, this is pretty much the holy grail of point of interest, right? If you see this zone, there's a very high chance that it's going to work because it not only broke structural, it also caused supply to demand to flip, and it also swept available liquidity when it's doing the flip. And then there is also inducements right here. There is also liquidity right here, which we can expect price to take out that liquidity when coming down, when pulling back to this point of interest right there, and that is when you can potentially get in for your trade. Now, like I said earlier, the more confluences the zone have, the higher the probability of it working. There's going to be other confluences which you need to take into account of as well, right? Things like your market structure. Okay, is this zone trading with the trend, or is this zone trading against the trend, right? Pro trend or counter trend. Example, demand zones in an uptrend is going to be more powerful than supply zones in an uptrend. Because in an uptrend, in a bullish market structure, we expect demand to be in control of price. We expect supply zones to fail and demand zones to work. And then another example is premium and discount, right? Ideally, we want to sell from supply zones that are within premium pricing and buy from demand zones that are within discount pricing. Not always, but most of the time. And then whether a zone is unmitigated or mitigated. If a zone is mitigated. Example right here when example right here. Okay, example right this one right here. Okay, this zone right here, it has been mitigated. Now, do you think this zone will work as well as a zone which has not been mitigated? Complete fresh zone just like this? Obviously not, right? The zone that is unmitigated is going to be higher probability, right? Because the orders right here have not been filled up yet. Okay, so that's something that you want to take into account as well. And then whether it is part of a S&D chain, right, a supply and demand chain. Remember earlier we talked about how if price is like doing this, price goes up, create a demand right there, and then after it breaks structural, it pull back down to this demand, and then reacted from it, causing another break of structural, creating another demand zone. You can see it's a very nice supply and demand chain just like this, right? In that case, we can expect the demand zone to continue working, to continue holding, right? So this is your chain. Okay, cool. So that is basically a few examples, right? Right now, what I want to do is to really combine all of this stuff together and show you guys like an example from a high level perspective, all right? And before I move on, just always remember, the more confluences the zone have, the higher the probability of it working. So when you are determining whether a zone is going to work or not, you just want to ask yourself, okay, what has this zone achieved? Did it break structural? Did it sweep liquidity? Did it cause supply to demand to flip, or vice versa? Is that inducement? Is it part of a supply and demand chain? Is it unmitigated? Is it within premium or discount? Is it within pro trend or counter trend? Like I said, the more confluences you have, the more things the zone actually achieve, the higher the probability of it working. So we can actually expect it to work better than the zone which has little to no confluences. Okay, so here's an example, a more complex example, but this is really where you really put your knowledge to test, right? Where you really see whether you actually understood what I've said so far or not. Right, so based on this, you can see this is a very obvious bearish swing structure. Price is creating your lower highs, lower lows, lower highs, lower lows, and this is when we know that supply is in control. So we can expect the demand zones to fail, and we can expect supply zones to actually work. Now, we can also expect the demand zones to actually become reaction points to actually facilitate the pullback in price, right? So since we are expecting, price to blast right through the demand zones, how do we know price is going to start pulling back, right? You look towards your left. You want to look for some sort of unmitigated demand zone that we have on the left hand side, and that is when you can expect price to mitigate it, and then price will start pulling back after the break of structure that we have right here. Okay, you can see price eventually come down, tap into this demand zone, mitigate it, and then start the swing pullback, right? Remember, we want to see that fractal market shift, we want to see that market shift in price that tell us that, okay, price is going to turn bullish to facilitate that pullback. So, at this point of time, you can see I've drawn up 3 points of interest right here. Which point of interest do you think price will most likely going to respect? Right? You want to find the one that has the highest probability of it working. That is the one that you want to trade from, right? You don't want to trade from zones that you know that it's not going to work. You want to trade from zones that is high probability, have a lot of confluences, have a lot of confirmation backing it up, right? A lot of evidence that actually prove to us that, you know what, this zone could potentially work. It has a much more higher chance of working than the rest of the zones, right? So based on this, let's examine zone by zone, okay? So within this, I also draw my premium discount tool that we have right here. I can see this will be the swing high, and this is the swing low, right? Since price is just break structure right here, and it started doing this significant pullback. Now, before that actually happened, you can see price did a minor pullback where price pushed down, minor pullback, and then go down even further. We cannot categorize this as a swing pullback because if you compare this to the previous swing pullbacks that we have, this is just a minor internal pullback, right? So this is just a pullback on the internal structure, which means that there is going to be liquidity being built up above this swing high that we have right there. Okay, cool. We're going to use that as our inducement. So what can potentially happen is that price is pulling back right here, okay, turn bullish to facilitate that pullback, and then it can tap into this first supply zone, right? That's our expectation. Price is most likely going to come into the first supply zone first. All right, then once it comes into this supply zone, ask yourself, okay, what has this zone achieved? If I think that this zone is going to work, I need evidence that show me that this is actually going to work. And how do I find this evidence? To actually determine what are the confluences that are backing up this zone. So if I look at this, right, this is a supply zone, okay, that actually broke structure, but not a swing structure, but it broke internal structure, okay. You can see this is an internal break of structure, right, to the downside. So that's that, right, not very high probability since it only broke internal structure instead of swing structure, right. So next is there is inducement being built up above this high, resting liquidity being built up above this high. So we can kind of expect this zone to fail because price is most likely going to go up there, sweep the available liquidity that we have above this high before going down even further. So yeah, most likely not going to respect it. And also, it's also within the discount zone, right? You can see right here, within the discount zone, the 50%, the equilibrium is below it. We are expecting price to actually pull back to above the 50% level, go into the premium pricing, and that is when we can really look for those high probability trade setups. Yeah, so based on this, by all now means you can trade from this, right? Sometimes what price can do is that price can make a minor pullback like this, come into this recent zone and then go, right? Price can do whatever you want. Sometimes this does happen, even though it's considered as a low probability point of interest, right? But this can happen as well. Another scenario could be price goes up there, pull back a little bit, building up more available liquidity above.
Boom. I think we've just found a hole in the matrix. Even though this is considered low probability, it can fuck with you.
High before price later go up there even further and sweep the available liquidity that have been created from this area right here and this swing high right there and this swing high right there, and eventually come up to either one of these zones that we have within the premium pricing, respect it, and then go down even further, right? So like I said earlier, you can trade from this, right? That there is no one size fit all. Like you can trade from this, but manage your expectation, because since this is a low probability point of interest, it's most likely going to have a minor reaction. So you can see price creating like a minor reaction just like this before going up even further to the other point of interest that we have right here. So if you were to sell at this area right here, be aggressive when it comes to your take profit, right? Maybe you can target some internal structure, like example, like some sort of internal wick low right there, and then yeah, get out right there and then take it to the next level right there. Okay, so let's say price did that, right? Price come down here, available liquidity right there, and then price goes up even further, creating high highs and high lows on the internal structure, completely neglecting the supply zone right there, and then it came into our second point of interest. Once again, you want to ask yourself, what has this point of interest achieved? That's the most important thing that you are trying to figure out when you are selecting your point of interest, when you are deciding which point of interest to trade from. So when it comes to this point of interest, look, okay, what confluences is backing up this point of interest. If you look at what happened right here, price comes down, created a swing high right there before it goes down even further, and then later on, price actually sweep the available liquidity before going down even further. So it swept liquidity, alright, cool. And then it also caused structure to break, right? It caused your break of structure right there. And then, most importantly, it actually caused your demand to supply to flip. Right, you can see if you look towards the left-hand side, what do we have right here? There's a demand zone right there. Price reacted from this demand zone right there, right? Creating that failed reaction. Remember, the failed reaction is key. Before price goes up there, sweep the available liquidity and go down even further. So yeah, we got a flip zone right here, your supply to demand flip. And then also, this zone is actually above the 50% equilibrium within our premium pricing. Okay, so we can consider this as a high probability point of interest since it has multiple confluences that is really backing it up. Like I said, you never ever want to rely on what you feel about that zone, right? You want to look for cohort proof that can actually back your buyers up, that can actually provide you with evidence that this zone is actually most likely going to work. Okay, and then later on, let's say price actually reacted from this zone, okay, pull back a little bit, might pull back all the way down to this last internal high low and then goes up even further, right? In that case, that is when we got our last line of defense, and it will be the most extreme supply zone that is situated at the last swing high, right? The last lower high in this case right here. So this is really the highest probability point of interest. Not only because of the fact that since it is indeed the last line of defense, and if price must respect this in order to continue the bearish swing structure, but it's also because of the other confluences that it has, right? So if you look at this zone right here, okay, it's an extreme zone. It also swept liquidity. You can see on the left hand side right here, liquidity being built up above this high, price swept it before going down even further. And then it also caused your break of structure, break of swing structure, and it's also within the premium pricing as well, right? And if you look at this closely, there could potentially be all your resting available liquidity above all these highs right there, right? So you can see by price pulling back all the way up here, it's sweeping all the available liquidity that we have over here on the left hand side, right? And then if you look at this closely, it's also considered as a demand to supply flip, since price could potentially react from some sort of unmitigated demand that caused this full pullback right there. Then price came up to here, creating the failed reaction, right? Your demand to supply flip as well. So this is indeed really the highest probability point of interest. Yeah, so you can see based on this, right? These two zones are considered as a high probability zone. And now the question becomes, okay, cool, Brad, thanks for telling us that. Which one to trade from? Now we got two zones, right? We have narrowed our focus to from 3 zones to 2 high probability zone. Now there is still 2 zones. Which one do I trade from? And the honest answer is that we will never ever know which point of interest price is going to mitigate. Which means price can come up to this zone and then go, or it can come up to this zone, this point zone, this extreme zone and then go. We will never ever know. That is why I always say, never assume, always react, right? Be patient and wait for your entry model to show up, then execute without hesitation. So based on this, for me personally, if I were to trade this, what I want to see is the internal structure to turn bearish, right? To tell me that the swing pullback is over, and then that is when you can potentially look for your trade setup. So it doesn't matter which zone is price gonna do that. As long as price do that, that is when you can actually look for your entry. So example, price goes up like that, creating high highs, come on this zone right here. Okay, available liquidity being built up above this high. Price goes up even higher, sweep the available liquidity from here and from here, and then price goes up even further, creating high highs, high lows, tap into the point, second point of interest, and this started to cause price to pull back a little bit, but next thing you know, price goes up even further. You can see continue creating the high and the high and the high low. As long as price is respecting the internal structure, the internal bullish structure, we are going higher and higher. I'm not going to look for sell yet, right? And eventually, you can see price came into our extreme zone, which is really the last line of defense, and then comes down there. This is the last higher low before price goes up even higher, and this is when I want to see price comes down, break the last higher low, break the internal structure, giving me the market shift that tell me that this swing pullback is over, and then I find the supply zone, the fresh supply zone that actually created this market shift on the lower time frame, and that is when I can look for my entry at this supply zone to short it all the way down. This is how I personally trade, and this is really how you should trade if you want to get the highest win rate, right? Is to wait for your entry model, wait for structure to shift in either one of these point of interest, and then take that trade. All right. Now this is what we call a confirmation entry, which you will learn later on. Another type of entry is risk entry, which means you are placing an order at the zone itself, right? That means you're not looking for confirmation whatsoever. You're just placing your order right here at this zone, and then eventually when price comes up to this zone, tap into it, your broker will automatically get you into the trade, right? So in that risk entry aspect, you are not looking for confirmation. You're just looking to enter. In that case, if you do choose to go with risk entry, make sure you place your order at a high probability point of interest. The last thing you want to do is to place your entry order at a low probability point of interest just like this, and then has the broker getting you into the trade, and then place your stop loss above this zone, and then next thing you know, price goes up even further and stop you out, and you get out with a huge loss, and you don't even know why. It's most likely because you are trading from a low probability point of interest. Okay, so yeah, that's risk entry and confirmation entry. Confirmation entry is when you are looking for your entry model to show up at the point of interest, then you enter for the trade. Risk entry is when, as long as price gets to that price point, I'm in. My broker will get me into the trade, and whatever price happens next, right, whatever thing that happens next, it is what it is. All right, that's risk entry. Yeah, so if risk entry, if you will place a risk entry in this scenario, you can potentially do so at point of interest number 2, this high probability point of interest that we have right there. Place your stop loss above this zone, and then place your take profit maybe at this weak low that we have right here. Because remember, in a bearish market structure, we are expecting price to create that lower lows and lower highs. Or in that case, let's say what happens is that price goes up there and actually get you into the trade right here, and then price goes up, right? You are in profit, but then price goes up even further and stop you out. In that case, then potentially, if you still want to continue trade the risk entry, then you can place another risk entry right here at the extreme zone, which is, like I said, the last line of defense, which you can be a little bit more aggressive with. And eventually, let's say price is up there, and then tap you into the trade right here when price tap into the point of interest number 3. Happy days. This is when you can see potentially price going in your way, and then price creating the entry model, and then go down in your way, and yeah, you can go and pop a champagne or something, and that happens. So that's my point, right? Risk entry or confirmation entry, whatever it is, just always know that we will never ever know which point of interest price is most likely going to respect. That is why we never ever want to assume, we always want to react, right? But like I said, that doesn't mean that we cannot show up unprepared. We still need to go and mark up our point of interest, right? Find the confluences, the confirmation that actually back up that point of interest, and then decide which one is high probability and which one is not, so that we can kind of expect price to react from the high probability zone, look for our entry model when price actually get into those zones, and then execute our trade without hesitation whatsoever. And just to summarize everything up, you always want to ask yourself, what has this point of interest achieved? Did it sweep liquidity? Did it break structure? Did it cause supply to demand to flip? Or vice versa? Is it in the discount or premium pricing? Is it pro trend, counter trend? Is it unmitigated? Is it fresh? All of these confluences will ensure that you pick the best point of interest. Because the more confluences the zone have, the higher the probability of it working. Alright, if not, I'm not going to talk any further. Next up, we will go onto the charts and actually try to apply whatever we have learned before we wrap up this entire
My instinct is I want to buy. I think I should. Just because I don't like being a pussy. Not being a pussy. Right. Yeah, I think I fucked up. But it's just the way this shit goes. I'm just like too early. I think prices. Like we have market shift. It's the downside. Right. So the plan moving forward, is we have we have to make this website solid so that it uses crypto. Should I just take a risk? Nah. Because we have a market shift. So at least we're looking for like down here, because we're in like a little range in itself. I could even fucking sell. it's gonna be slow. So I just don't trust any of it. So, I saw this website. So I'm gonna get on with that. What a fucking crazy amount of work. Which is why we need to think about this logically, bro. Because currently I'm like just very excited. Which isn't a terrible thing, but it's also bad if you're trying to run a business, because the boring process of being repetitive is not something to get that excited about. So in this case, excitement has no real benefit, and it's ironic because that's something to get excited about. Get excited that excitement isn't needed. Peace and love, prosperity, all the good stuff. Let's go on with our day, smash it, come back, positive mind.